Societal perception of wealth often begins with immediate thoughts upon encountering a wealthy individual. This initial reaction reveals underlying assumptions about financial success and its origin. One common perspective attributes wealth to diligent effort and sustained hard work. This viewpoint emphasizes meritocracy and the rewards of personal endeavor. Conversely, another common reaction questions the methods employed to accumulate wealth. This perspective often reflects skepticism regarding fairness, ethics, or systemic advantages. Economic disparity illustrates the uneven distribution of wealth and income within a population. This phenomenon reveals a stark contrast in economic outcomes among different groups. During specific periods, some individuals or entities accumulate significant wealth. Simultaneously, millions of others experience a decline in their economic standing. This decline often occurs despite increased effort or productivity from these individuals. Such visualizations highlight the growing gap between the affluent and the economically struggling. A fundamental question arises regarding the fairness of the economic system. Despite claims of fairness, wealth consistently flows upwards. This leads to a concentration of wealth among a select few individuals. This observation challenges the inherent fairness of the system. It also questions the notion of a purely meritocratic system. Such a system implies that effort directly translates into proportional reward. Systemic unfairness in a system raises ethical questions regarding accumulated wealth. If a system is inherently unjust, the moral standing of fortunes gained within it becomes questionable. This establishes a direct link between the fairness of a system and the ethical purity of wealth. The legitimacy of individual financial gains is tied to the justice of the underlying structure. Therefore, systemic injustice can compromise the moral integrity of wealth accumulation. This concept highlights the ethical responsibility associated with economic and social systems. The concept of luck is often invoked to explain disparities in wealth and success. This perspective suggests that external, uncontrollable factors primarily determine an individual's financial standing. The scene explores whether this attribution to luck is a genuine belief or a strategic simplification. It questions if luck serves as a convenient means to avoid deeper ethical scrutiny of wealth accumulation. Furthermore, it examines if this justification sidesteps personal responsibility for economic outcome. This module explores the concept of avoiding moral responsibility. It specifically investigates the luck justification for wealth. We examine if this explanation serves as a mechanism to evade moral obligation. This evasion concerns the origins and implications of personal wealth. The luck narrative may allow individuals to distance themselves from uncomfortable truths. It analyzes how such justifications impact accountability regarding wealth distribution. A critical question arises regarding the pathways to significant wealth in contemporary society. It probes whether insider information is a prerequisite for achieving substantial financial success. Another aspect questions the necessity of political protection to accumulate great riches. This highlights potential non-meritocratic avenues, suggesting wealth may stem from others' losses. Insider information refers to non-public data about a company or market. Access to this information provides an unfair advantage in financial markets. Individuals can use it to make profitable trades before information becomes public. This leads to wealth accumulation, not based on general market participation or innovation. Political connections play a significant role in the accumulation of wealth for certain entities. These connections can manifest as political protection, shielding businesses or individuals from competition. One mechanism is the implementation of favorable regulations that benefit specific groups. Another is the awarding of government contracts, often without competitive bidding processes. Policies may be enacted that disproportionately favor certain entities or individuals. This dynamic can lead to wealth, concentration, and economic disparities within a society. Wealth generation can occur through the exploitation of others. This process involves one party's gain directly corresponding to another's loss. Such exploitation often arises from imbalanced power dynamics between parties. Unfair labor practices are a common mechanism for this type of wealth transfer. The system benefits one group by extracting value from another. This module illustrates the mechanisms by which wealth is accumulated through such means. Consider a hypothetical scenario: sudden acquisition of immense wealth. This scenario prompts a critical question regarding one's ethical compass. Would personal values and moral principles remain steadfast, or would the influence of vast riches lead to a shift in ethical behavior? This introspection explores the potential corrupting power of immense wealth on an individual's ethics. The concept of wealth often raises the fundamental question of its inherent nature. This involves examining whether wealth itself is intrinsically innocent or morally neutral. A common perspective views wealth as a benign outcome, a direct result of effort and productivity. Conversely, a critical view questions this, suggesting potential ethical complexities tied to wealth accumulation. This concept explores the provocative idea that wealth can be a form of legalized exploitation. It suggests that certain economic practices, while adhering to legal frameworks, may be ethically problematic. The core argument centers on the distinction between legality and morality in wealth accumulation. This perspective challenges the inherent innocence often associated with wealth generation. It prompts an examination of systemic structures that might enable such exploitation within legal bounds. The discussion focuses on the ethical implications of economic systems and wealth distribution. Systemic inequality refers to how societal structures inherently create and perpetuate disparities. These structures are embedded within institutions, policies, and cultural norms. They often lead to an uneven distribution of resources, opportunities, and power. This can result in wealth concentration at the top of the socioeconomic hierarchy. Conversely, it can cause stagnation or decline for those at the bottom. Understanding these structures is crucial for addressing persistent social and economic disparities. Meritocracy suggests that success is solely based on individual talent and effort. This concept often creates an illusion of fairness in economic and social systems. However, external factors significantly influence an individual's path to success. Starting conditions, such as socioeconomic background, play a crucial role. These initial advantages or disadvantages can overshadow individual effort. Thus, the module deconstructs how these elements challenge the meritocratic ideal. Financialization describes the increasing dominance of financial markets and institutions in the economy. It shifts wealth generation from producing goods and services to financial instruments. This process involves speculation and abstract accumulation of capital. The economy becomes more reliant on financial activities rather than traditional production. Regulatory capture occurs when regulatory bodies, meant to act in public interest, are influenced by the industries they oversee. Powerful entities leverage this influence to shape regulations, creating rules that favor their specific interests. This manipulation facilitates the accumulation of wealth for these entities, often at the expense of broader public good. The concept highlights a systemic vulnerability where private interests can subvert regulatory oversight. Inherited wealth plays a significant role in perpetuating economic disparities across generations. Initial financial advantages can compound over time, creating substantial gaps in wealth. This accumulation of wealth often occurs independently of an individual's personal merit or effort. Such inheritance contributes to the persistence of economic inequality within societies. Complex tax systems often contain various loopholes and mechanisms. These provisions allow wealthy individuals and corporations to minimize their tax contributions. The use of offshore accounts is a common strategy for tax avoidance. Such practices contribute to the further concentration of wealth. Global wealth disparities highlight the uneven distribution of resources and opportunities worldwide. These disparities are influenced by complex economic structures. Historical factors also play a significant role in shaping wealth distribution. This leads to significant differences in economic well-being across nations and populations. Capital, once accumulated, possesses the inherent ability to generate further wealth. This wealth generation occurs through strategic investments in various assets or ventures. These investments yield returns, which then contribute to the growth of the initial capital. This process creates a compounding effect, where earnings generate further earnings over time. The compounding power of capital can ultimately outpace wealth accumulation solely from labor income. Philanthropy by the wealthy often faces ethical scrutiny regarding its true impact and motivations. A key question is whether it genuinely addresses underlying systemic issues in society. Critics argue that some philanthropic efforts may not challenge the origins of accumulated wealth. Instead, it might inadvertently serve to legitimize the wealth without structural change. This raises concerns about whether philanthropy maintains existing power structures. The ethical debate centers on effective social change versus maintaining the status quo. The classical economic concept of the invisible hand posits that individual self-interest benefits society. This theory suggests that free market forces, without intervention, guide resources efficiently. However, a re-evaluation questions if this mechanism ensures equitable wealth distribution. The debate centers on whether markets alone can prevent wealth concentration. This reassessment explores the inherent tendencies of market dynamics on societal equity. Extreme wealth concentration can significantly impact democratic processes. It often leads to reduced social mobility, hindering opportunities for many. Such disparities can erode overall societal cohesion and foster division. These consequences highlight the broader implications of wealth inequality on society. The discussion on wealth necessitates continuous critical reflection. This involves examining the origins and ethical implications of wealth accumulation. It also requires scrutinizing the systemic fairness inherent in wealth distribution. Viewers are encouraged to actively engage with these complex questions, avoiding simplistic answers.